Right now, across trading desks and financial news feeds, silver is still being framed as a marginal story, a commodity moving within a familiar range, a market behaving roughly as expected. Screens continue to show spot prices that suggest stability, liquidity, and control. Yet, at the same time in Tokyo, verified physical transactions are clearing at levels above $120 an ounce, a figure that stands in open contradiction to the price signals transmitted by Western paper markets. This discrepancy is not being highlighted in mainstream coverage because it does not fit the prevailing narrative of orderly markets and contained inflation. By the end of this analysis, it will be clear that this is not a pricing anomaly, nor a temporary premium driven by local demand, but a structural disconnect that reveals a deeper fracture in how value is discovered and enforced in the global financial system. This investigation will remain grounded in observable data and systemic mechanics rather than prediction, and as the evidence unfolds, the central question becomes unavoidable. If silver is already trading above $120 in Tokyo, what does that say about the integrity of the price still flashing on screens elsewhere? For decades, the global silver market has been understood as a layered system in which a centralized paper price, primarily set through futures exchanges, serves as the reference point for all physical transactions worldwide. This system rests on the assumption that paper contracts are reliably convertible into metal, that arbitrage functions smoothly across regions, and that any regional premiums are temporary frictions rather than signs of structural failure. Under normal conditions, if silver were meaningfully more expensive in one region than another, market participants would move metal from low-price areas to high-price areas until the gap closed, reinforcing the authority of the global benchmark price. This framework has been treated as stable not because it is perfect, but because it has historically been resilient enough to absorb shocks without visibly breaking. What is now becoming apparent is that several of the assumptions underpinning this structure are no longer holding simultaneously. Physical demand is no longer evenly distributed, logistical capacity is no longer elastic, and monetary confidence is no longer uniform across regions. In Japan, where the currency has been under sustained pressure and purchasing power erosion is no longer theoretical, physical silver is being acquired not as a speculative asset, but as a defensive necessity. When price discovery shifts from speculative expectation to immediate preservation, the paper reference price loses authority. The fact that transactions are clearing above $120 in Tokyo is not evidence of irrational exuberance, but of a localized market responding to conditions that the global benchmark is failing to reflect. This is where the system begins to show visible stress. In a functioning arbitrage environment, such a discrepancy would invite immediate correction. Yet the gap between Tokyo and Western markets is not narrowing. Instead, it is persisting and, in some cases, widening. That persistence is the signal. It indicates that barriers, whether logistical, regulatory, or institutional, are preventing the free flow of metal that the pricing model depends on. Once arbitrage ceases to function effectively, the paper price no longer represents a clearing mechanism, but a reference detached from reality, maintained by convention rather than enforcement. History offers multiple examples of markets that appeared stable until confidence quietly migrated elsewhere. One of the most relevant parallels can be found in the breakdown of the London gold pool in the late 1960s, when a consortium of central banks attempted to maintain an official gold price, despite rising physical demand and declining trust in fiat convertibility. At the time, the official price was treated as immutable, backed by institutional authority and coordinated intervention. Yet beneath the surface, physical demand steadily drained reserves as market participants exploited the gap between the official price and real-world valuation. The system did not fail because of panic, but because it was mathematically unsustainable once confidence shifted faster than supply could respond. In that episode, authorities attempted to stabilize the market through increased coordination, temporary closures, and narrative reassurance. But these measures only delayed the inevitable repricing. When the pool collapsed, it was not the result of a single event, but of cumulative pressure that finally overwhelmed the available buffers. The official price ceased to exist as a meaningful reference, and a new market reality emerged almost overnight. The relevance of this precedent lies not in the specific asset, but in the mechanism. When physical demand decouples from institutional pricing, the institution eventually yields. What makes the current silver situation particularly instructive is that the disconnect is not occurring quietly or in isolation. It is visible, measurable, and geographically concentrated in regions experiencing monetary stress. Tokyo's pricing is not an outlier in the sense of a fringe market, but a major financial center responding rationally to local conditions. The silence surrounding this development is itself a signal, suggesting that the implications extend beyond commodity pricing and into the credibility of the pricing system itself. As this historical pattern begins to repeat, the question is no longer whether the gap exists, but whether the system designed to suppress it still has the capacity to do so. The breakdown of the London gold pool offers another critical lesson that applies directly to the current silver disconnect. When the official price finally failed, it did not adjust gradually. Instead, confidence collapsed abruptly, and with it the ability of institutions to manage the transition on their own terms. The repricing that followed was disorderly, politically sensitive, and deeply destabilizing for those who had relied on the old benchmark as a permanent anchor. Importantly, the warning signs were visible well in advance, but they were dismissed because the system had always worked before, and because the authority enforcing the price was assumed to be stronger than the market forces challenging it. A similar dynamic unfolded during the Asian currency crisis of the late 1990s, where official exchange rates were defended long after they had lost credibility. Governments insisted that fundamentals were sound and that speculative pressure would pass, yet capital flows told a different story. Once confidence tipped, reserves drained rapidly, pegs failed, and prices adjusted violently. In each case, the critical failure was not a lack of tools, but a misjudgment of timing and scale. Authorities underestimated how quickly confidence could migrate once participants recognized that the system was operating on borrowed credibility rather than surplus capacity. These episodes underscore a recurring pattern in markets that depend heavily on trust, liquidity, and the perception of convertibility. As long as participants believe that claims can be honored without friction, prices remain stable even under stress. But when that belief weakens, the system enters a phase where signals become inconsistent. Paper prices continue to project calm, while physical markets begin to reprice independently. Early observers often misinterpret this divergence as noise, speculation, or temporary distortion, precisely because it does not conform to established models. By the time the disconnect becomes undeniable, the adjustment is already underway. This pattern recognition is essential for understanding what the Tokyo silver price represents today. The gap between Western paper prices and Eastern physical prices is not merely a premium driven by cultural preference or regional demand quirks. It is a signal that the market is fragmenting along lines of trust and accessibility. In regions where confidence in currency stability and financial intermediaries is weakening, physical assets command a materially higher valuation. In regions where institutional frameworks still project stability, paper claims continue to trade at lower levels. The divergence persists because the assumptions that once unified these markets are no longer universally accepted. Crucially, this process does not require a dramatic trigger to accelerate. It feeds on cumulative pressure and delayed recognition. Market participants who are early to notice the shift quietly adjust their behavior, reducing exposure to paper claims and increasing preference for deliverable assets. This behavior reinforces the divergence by draining physical supply from markets anchored to paper pricing. Each transaction executed at a higher physical price validates the decision of the next buyer, gradually establishing a new reference point that operates outside the traditional benchmark. At this stage, the system often appears deceptively stable to those focused solely on headline prices. Futures markets continue to trade with apparent liquidity, volatility remains contained, and official commentary emphasizes normalization. Yet beneath this surface, the structure is changing. The pricing authority of the paper market erodes incrementally as more transactions clear at levels it cannot reconcile. The question that follows naturally is whether this time will conform to the familiar pattern of eventual stabilization, or whether structural conditions have shifted enough to alter the outcome entirely. That question leads directly into the most consequential aspect of the current situation: the constraints that distinguish this episode from those that came before. The conditions that allowed past systems to absorb stress and reassert control may no longer exist in the same form. To understand why, it is necessary to examine what has changed in the modern financial and geopolitical landscape, and why those changes materially limit the range of available responses. What distinguishes the current silver disconnect from earlier episodes is not the presence of stress itself, but the absence of meaningful buffers that once allowed institutions to absorb that stress without relinquishing control. In previous cycles, central banks and large intermediaries possessed ample reserves, flexible supply chains, and a geopolitical environment that allowed coordination across borders. Today, those conditions no longer exist in aggregate. Inventories of readily deliverable silver are materially lower relative to demand. Supply growth is constrained by years of underinvestment and declining ore grades, and industrial reliance on silver has intensified rather than diminished. Unlike past episodes where financial demand dominated, modern silver consumption is structurally embedded in electronics, energy transition technologies, and advanced manufacturing, creating a non-negotiable baseline demand that does not recede simply because prices rise. At the same time, policy flexibility has narrowed. Monetary authorities are already managing elevated debt levels, persistent inflation pressures, and fragile currency confidence. The capacity to suppress price signals through coordinated intervention is constrained by the risk of exacerbating broader macroeconomic instability. In Japan, this constraint is already visible. Yield curve control has strained credibility, the currency has absorbed the adjustment, and households have responded by seeking tangible stores of value. When a developed economy reaches the point where physical metals are preferred over financial claims, it signals not panic, but adaptation to perceived policy limits. That adaptation is rational, and it spreads through demonstration rather than decree. Geopolitical fragmentation further amplifies these constraints. Supply chains that once operated on efficiency now operate on resilience, redundancy, and political alignment. Strategic materials are increasingly subject to export controls, licensing regimes, and informal prioritization. Silver, while not always labeled as such, is increasingly treated as a strategic input due to its role in energy infrastructure and defense-adjacent technologies. As a result, the free flow of metal that arbitrage depends upon is no longer guaranteed. Even when price differentials exist, moving physical silver across borders involves regulatory scrutiny, logistical delays, and rising costs that blunt the corrective mechanism. These factors combine to create an environment in which the traditional response toolkit is insufficient. Authorities cannot simply inject liquidity, release reserves, or rely on market makers to smooth discrepancies without confronting second-order effects that propagate elsewhere in the system. The result is a market that remains nominally functional while becoming progressively less coherent. Prices persist, but they no longer converge. Signals exist, but they conflict. The Tokyo price above $120 is not forcing immediate alignment because the system lacks the elasticity to respond quickly without breaking something else. This brings the analysis into the near-term pressure window, the period in which these accumulated constraints are most likely to converge. The catalysts are not hypothetical. Currency volatility, particularly in Asia, continues to drive defensive asset allocation. Industrial procurement cycles are tightening as manufacturers seek to secure inputs ahead of potential shortages. Meanwhile, Western paper markets remain exposed to the assumption that physical availability can be sourced when required. Any disruption, whether logistical, regulatory, or confidence-driven, has the potential to accelerate the repricing process. The stakeholders involved in this window have competing objectives that limit coordination. Financial institutions prioritize balance sheet stability and controlled volatility. Industrial buyers prioritize continuity of supply regardless of price. Households in stressed currency environments prioritize preservation of purchasing power. These objectives are not aligned, and in periods of scarcity, the actor willing to pay the highest price for immediate delivery sets the marginal valuation. Increasingly, that actor is not a financial trader, but an end user or defensive buyer operating outside the paper market framework. As this pressure intensifies, responses are likely to become reactive rather than strategic. Measures taken to stabilize one segment of the system may exacerbate stress in another. A paper price held artificially low encourages physical drawdown. A sudden attempt to raise the paper price risks destabilizing leveraged positions. The system oscillates between these outcomes until an external constraint forces resolution. The unresolved tension at this stage is not whether adjustment will occur, but where it will be absorbed, and by whom. As this divergence becomes more visible, a parallel effort emerges to manage perception rather than address structure. Official reassurances continue to emphasize that premiums are localized, that futures markets remain liquid, and that no formal default has occurred. Commentators point to historical volatility, recycling flows, or temporary demand spikes as explanations, framing the situation as familiar rather than exceptional. These narratives rely on a narrow definition of stability, one that equates orderly trading screens with systemic health, while ignoring the distinction between contractual liquidity and physical accessibility. The absence of overt crisis signals is presented as evidence that the system is functioning, even as the underlying mechanisms strain to reconcile incompatible realities. What these reassurances fail to account for is the difference between narrative stability and actual resilience. A system can appear calm precisely because its constraints prevent rapid adjustment. Suppressed volatility does not imply reduced risk. It often indicates that risk has been displaced into areas that are less transparent and harder to measure. In the case of silver, the persistence of a low paper price alongside elevated physical clearing levels is not a sign of equilibrium, but of deferred reconciliation. The longer the disconnect persists, the more severe the eventual alignment tends to be, because imbalances accumulate rather than dissipate. There is also a tendency to conflate the absence of widespread public concern with the absence of systemic stress. Yet historically, market transitions are not driven by mass participation at the outset, but by incremental shifts among informed actors responding to constraints ahead of consensus. By the time a pricing discrepancy becomes widely discussed, the underlying adjustment is often well advanced. The current silence surrounding Tokyo's pricing is therefore not reassuring. It suggests that the implications extend beyond commodity markets into areas that institutions are reluctant to address openly, including the credibility of price discovery itself. At its core, the situation revealed by silver trading above $120 in Tokyo is not about speculation or regional anomaly. It is about the fragmentation of a global pricing system under the weight of competing realities. One reality is anchored in financial abstraction, where prices derive from leveraged contracts and managed expectations. The other is anchored in physical necessity, where price is determined by availability, urgency, and confidence in currency. When these realities diverge, the one tied to physical constraint ultimately prevails, not by argument, but by enforcement. This is not a single event that will resolve neatly with a headline or policy announcement. It is an ongoing process, unfolding unevenly across regions and sectors, driven by structural limits rather than intent. The Tokyo price is a signal, not an endpoint. It reflects conditions that are already present and expanding, even if they have not yet been acknowledged by the benchmarks that dominate Western financial discourse. As this analysis concludes, two questions remain central. If physical silver is already clearing at levels far above the global reference price in a major financial center, how long can the existing pricing framework maintain credibility without reconciliation? And if that reconciliation occurs under constraint rather than coordination, where will the adjustment be absorbed, and who will bear its cost? These are not abstract considerations, but practical ones that will shape market behavior in the months ahead. For continued coverage of developments that emerge at the structural level before they are reflected in headlines, follow this channel and remain engaged as this situation evolves. The most consequential shifts in financial systems rarely announce themselves clearly at the outset, but they leave signals for those willing to examine them closely.